Good morning, everyone. Thank you for joining us today and welcome to the Rasmala Real Estate Funds webinar update. My name is Eric Swatz and I'm the Senior Executive Officer at Rasmala based in our office in the DIFC. Before turning the presentation over to Ruggiero, the fund manager of the real estate funds, I'd like to share with you a short summary of our asset management business and our capabilities. Today, Rasmala manages close to $1.7 billion in assets under management in various strategies across both conventional and alternative investments, and with an emphasis on delivering Sharia-compliant investment solutions for our clients in the UAE and the wider GCC markets. With some 35 investment professionals based in our DIFC office, we are one of the largest independent asset managers in the region. We have been operating in these markets for over 20 years, and we have a long-term track record of investment success. And while the current health and economic environment is unique, it is not the first crisis through which we'll be operating. Today's webinar is about our real estate capabilities, and in particular, our real estate funds. The Long Income Fund, the European Real Estate Income Fund, and the North American Real Estate Income Fund. Collectively, these funds have approximately $500 million in assets under management, consisting of stakes in 170 commercial properties, over 64,000 residential properties, and 50 REITs. We have a dedicated team of 6 investment professionals in our real estate business, and we are further supported by several local partners who operate on-the-ground presences in the markets where we invest. Our investment capabilities cover direct investments in real estate properties, investments into listed real estate trusts or REITs, as well as investments into third-party funds managed by specialist investment managers. As we recover from the health and economic emergencies which have swept the world recently, we are all examining, confirming, and/or reconsidering our investment strategies. We at Rasmala are confident that real estate in general, and real estate funds in particular, will continue to play a key role in client investment portfolios for the immediate and longer term. On the next slide, we have listed some of the key features which set our open-ended funds apart from other products in the market. One of the unique features of our funds is that they pay monthly fixed distributions, as opposed to many other real estate investment products where distributions are paid on a quarterly or semi-annual basis. The funds are designed to have a low volatility, and when added to a multi-asset portfolio, contribute to lowering the overall risk measured by the standard deviation of that portfolio. Unlike many real estate investment products, which lock investors' capital for long periods of time, our funds are open-ended with unit prices published daily. Liquidity is achieved through a variety of mechanisms and includes the use of REITs, as well as access to institutional secondaries market for real estate funds. The funds offer an opportunity to invest in the US, the European Union, and the United Kingdom. We also invest in multiple sectors directly or indirectly via best-in-class managers with a presence on the ground in the markets where they invest. Given the predominant preference for US dollar investments, wherever appropriate, our funds implement Sharia-compliant hedging techniques to manage currency risk. The portfolio of our funds typically comprises 4 components. We have cash or short-term investments, real estate investment trust or REITs, open-ended direct property funds, and direct investments and co-investments. The percentage allocation to these components varies among our funds. However, in general, we aim to keep between 20 to 30% of our funds invested in cash and REITs to ensure that we maintain an appropriate liquidity buffer in order to meet investor redemption requests. Open-ended direct property funds provide us instant diversification and access to the expertise of best-in-class managers with teams on the ground. These funds usually have minimum investments of between $5 million and $10 million, and are not easily available to private investors. Finally, we make direct investments and co-investments in single assets where we have high conviction. These investments carry a slightly higher degree of leverage, which is designed to enhance the overall performance of the portfolio. The dotted line around the portfolio shows our currency hedging overlay, which is implemented for our investments in the United Kingdom and the European Union to avoid the short-term fluctuations of the British pound and the euro that these fluctuations might cause on the NAV. And now let me turn the presentation over to Rogero, who will take us through the next slides discussing the strategy, the portfolio position, and the performance of these three funds. Thank you.
Thank you, Eric, and good morning, everyone. So let me start with an overview of the 4 megatrends which guide us in the construction of our portfolio. First of all, we observe that our economy is in the midst of a digital transformation. The universal adoption of smartphones and other forms of digital communications are transforming our lives from the way we shop, we do business, or study. And this transformation is impacting the real estate market. For example, the shift to online shopping is reducing the demand of high street stores and increasing the demand of warehouses from where goods are dispatched to consumers. But also, the growth of technology companies is increasing demand of commercial real estate dedicated to service the needs of those companies, from digital parks to data centers. We are in the midst of a transition for traditional fossil fuels to renewable energy. For real estate investors, this process has opened opportunities to invest in solar and wind farms, as well as in battery storage parks, which provide the bridge between intermittent production of energy from renewable sources and the demand from consumers, which is a different cycle. Also, the energy transition is impacting traditional assets like offices, which, together with residential properties, are the main producers of CO2 for heating and cooling. As governments enact ever more stringent energy efficient requirements, offices with green credentials will become a more appealing proposition to investors. The third megatrend we observe is a move towards sustainable urbanization. The recent pandemic has given everybody a pause for thought and an opportunity to learn how to live and work smartly from our homes. We are expecting that the lessons learned over the last 18 months will not be lost, and that gradually our cities will improve and become more sustainable. For real estate investors, this megatrend provides an opportunity to invest in energy efficient and smart rental homes, as well as explore niche areas like serviced apartments, which can deliver superior returns through active management by a specialist operator. Furthermore, investing in sustainable urbanization means that we can explore opportunities in niche sectors like student housing, affordable housing, social housing, properties designed with a more sustainable standard in mind. And finally, we observe a general trend towards the aging of the population. Improvements in healthcare and in general of our living standards means that we are living longer. And as the number of elderly increases, the demand for healthcare services continue to increase. For real estate investors, increased demand for healthcare services translates in opportunities to invest in care homes, life science laboratories, and primary healthcare properties, assets which tend to benefit from secure income underpinned by long-term lease agreements. Now, over the next 3 slides, I will provide the target returns of our 3 funds. The way we formulate these target returns is by reference to sector forecasts produced by main research houses and to our portfolio, to our model portfolios. Although there is no guarantee that these targets will be achieved, breaking down the sources of income helps us to set our monthly distributions, which are a distinctive feature of our funds. Now, the first slide shows how we have set the 5% per annum fixed monthly distribution of our long income fund. As you can see, the bulk of the return comes from the gross income of the fund, which is driven by the rent earned on these properties. Capital gains are typically linked to the growth of income, which is assumed equal to inflation. We are not factoring yield compression in our current forecast, as we think yields are already low. Then we remove expenses and reach a final number to set our monthly distribution of 5% per annum. Now, this projection assumes that over the next 5 years, we will introduce about 25% leverage in our portfolio by gradually increasing the REITs, which typically have a 30 to 40% leverage, and direct investments, which typically have a 50 to 60% leverage. Turning to the European fund, the 5 years target average annual return is 8.1%, again primarily driven by a gross income of 7.53%. Now, bear in mind that this fund uses a higher degree of leverage to generate this income. And this leverage is approximately 40 to 50% at portfolio level, which implies a slightly riskier profile than the long income fund. Next, we are turning to the North American fund, where we see that our 5-year target return is slightly higher at 8.56% per annum on account of the slightly better expected return of this market relative to the UK and continental Europe. Similar to the European fund, the North American fund uses approximately 40 to 50% leverage to achieve its target return and implies a slightly higher degree of risk than the long income fund. Now, turning to the portfolio update. Our long income fund has a WALT in excess of 55 years and is invested primarily in residential, retail, industrial, and logistics sectors. Our residential exposure comprises primarily residential ground rents, which provide long-term secure income. The retail exposure comprises primarily essential retail assets like supermarkets, which have proven to be extremely resilient during the current pandemic. Our industrial and logistic exposure includes a number of properties used for e-commerce or in general for storage and movement of goods. Besides these traditional sectors, we are also exposed to a number of alternative sectors like hotel and leisure, healthcare, and education, where it is possible to find properties with long leases and inflation linkage. We do also have exposure to economic infrastructure, assets like data centers, solar and wind farms, which provide long and secure income. In terms of geographical location, we are primarily exposed to the United Kingdom, in line with the original design of this fund. The exposure to North American and European and continental Europe represents around 30% of the portfolio and adds diversification to the sources of income. Finally, in terms of portfolio composition, the fund is currently overwhelmingly invested in direct funds, which have enabled us to provide diversification across multiple assets and sectors from the very beginning. As overall assets of the fund grow, we expect to reduce this allocation over time and to increase the allocation to REITs to about 20% to increase the liquidity of the fund, and to increase the allocation to direct investments to enhance the returns of the fund. Now, moving to the European Real Estate Income Fund, we can see that industrial and logistics represent over 25% of the portfolio, reflecting our high conviction in this sector. The second highest allocation, at about 17%, is to the hotels and leisure sector, where we expect a recovery of the next 12 months, as finally the pandemic subsides. Offices and laboratories represent just above 13%. Our exposure here comprises properties which are expected to be relatively resilient to the expected changes affecting the sector. We do believe that the increase of flexible working practices will have a negative impact on the demand of offices. But more importantly, we see a clear risk associated to properties which do not meet energy efficient standards, where the cost of retrofitting the properties will lead to a quick depreciation of the building. In terms of geographical location, we are currently overweight in the United Kingdom, where we see a better short-term opportunity to generate returns relative to continental Europe. We expect, however, to reduce this overweight over the next 24 to 36 months. In terms of portfolio composition, the European Fund is primarily invested in direct funds to ensure we continue to maintain this diversification. However, we expect to reduce the exposure over time to around 20 to 30% and replace it with direct investments. The exposure to REITs has been reduced below 10%, where we have it's been reduced below 20% to reduce the volatility of the NAV. We are expecting to see central bank to start to withdraw their pandemic stimulus. So reducing REITs means that we reduce the liquidity profile of our fund. However, we are confident to being able to meet normal redemption requests using our holdings in open-ended funds. Finally, you can see that our North American fund is essentially invested in offices and research laboratories and in economic infrastructure assets. This fund is essentially investing in 13 data centers and 1 research laboratory. It is a relatively small fund. Now, at the beginning of this quarter, we reduced our REIT exposure in anticipation of our market liquidity and opted to maintain a relatively high cash level, which we plan to redeploy over the next 12 months. Now, turning to the performance, we provide both the total returns and distributions, cash distributions of our 3 funds. Starting with the Long Income Fund, where we are completing our 3rd full year of activity. Now, you can see that we are on target to achieve our 5% distribution for the year. These numbers are at the 31st of August. The total return has, however, lagged so far this year, primarily on account of the lack of performance of some of our open-ended funds, which had to increase their level of liquidity to meet a number of redemption requests to those funds. Now, hopefully, this situation should improve over the next 6 months, with total return rising towards the 5% per annum target, which will cover the monthly dividend. Turning to the European Fund, this fund is running on target to achieve its 8% target for the year, on the back of the positive performance recorded during the first part of the year. As of 31st of August, we have generated just over 7% total return, and with 3 months to go to the end of the year, we should achieve our 8% target in both total returns and distributions. As for the North American fund, we have already exceeded our 8% target for the year. As of 31st of August, we have achieved 12.83% year to date. So for the rest of the year, I would expect to add another 1.5% purely from rental income, which should bring us to a level comparable to the 13.85% we achieved last year. Now, clearly, these are exceptional returns, which have been achieved by carefully playing the recovery of the market after the equities market, after the large drawdown of March 2020, where we entered the REITs market and were able to play to the recovery. Looking forward to 2022 and beyond, I would expect a more average return of 8% per annum. Now, this concludes my presentation on the performance and the composition of the portfolio. I turned the line to Sarah, as I believe she had a couple of questions.
Thank you, Rogero. We received a few questions prior to the recording. The first one being, when are you going to be able to remove the deduction for dilution adjustments from redemptions out of the long income fund?
Thank you, Sarah. So our long income fund has been able to accept redemptions for the last 12 months. And all requests presented so far have been met without delay. Our liquidity buffer is, however, low, and we had to apply a dilution adjustment, which in effect reflects the cost which were incurred at the time of acquiring the properties and cannot be properly amortized. Now, we are currently trying to raise the liquidity buffer above 10% of the portfolio, at which point we will be able to remove the dilution adjustment. If our plan is successful, we should be able to remove it in the next couple of months.
Great, thank you, Rogero. There's one more question we received. Last quarter, you mentioned the possibility of exiting the fund without a dilution adjustment via a redemption plan. Is that happening?
Yes. So the director of the fund have approved the queuing mechanism to accept a certain number of redemptions every month and settle the same without the dilution adjustment. Actually, I have a slide. So let me show how this mechanism works. So investors who want to enter into the exit queue can submit the redemption request to the administrator and at the same time notify the investment manager that their redemption request should be entered into the monthly bucket. So there will be one bucket formed for every month. So for example, let's assume that in September we receive 6 redemptions totaling $22 million, and that these investors elect to go in the exit queue without paying the dilution adjustment. So the investment manager will accept these redemptions at the full NAV and assign to each redemption a pro rata entitlement. Over the following months, the investment manager will make available cash to redeem these investments until the full amount has been redeemed at NAV. The same process is repeated every month. So for example, all redemption requests received in October will form the October bucket and will be dealt together as soon as the September bucket is fully liquidated. Clearly, the more cash the investment manager can make available for this redemption, the sooner a bucket can be cleared so that the next can be addressed. Now, the queuing system is a standard system of open-ended real estate funds, and it is designed to address the liquidity requirements of the investors who want to exit without damaging the interest of the investors who want to remain. So the liquidity made available for the remaining investors is extracted from the portfolio at no cost, so as not to create a drag on the performance. Clearly, this is a gradual process which needs to be coordinated with other managers. So in the case of the long income fund, The bulk of this liquidity sits with the time investment funds, and its availability depends on our successful negotiation to place a redemption request in those funds at no cost. This is usually best done in a staggered way over a number of months, using the incoming liquidity from subscriptions in those funds or from planned sales of assets. Is there any other question, Sarah?
None anymore from our side. Thank you, Rogero.
Great. So if there are no further questions, we can close this webinar, and thank you for attending.
Thank you.